welcome to our webinar this morning. Special warm welcome to Graeme Zacks. Graeme, thank you so much for your time today. Graeme's going to be talking in particular about debt, as he is probably one of the most specialized people in our community on this topic. So yeah, for those of you, I think most people on the call by now do know about ORT and the work that we do, but for those that don't, ORT runs a mentorship program for Jewish entrepreneurs in our community. We also offer networking and training, and we have been hosting these webinars weekly throughout the lockdown period. So if you're not on our database, please just send your email address to, you can even put it in the chat box, Lisa or myself. Graeme's going to be talking for about 45 minutes. And if anyone has questions during the talk, please put it into the chat box and Lisa will go through them at the end. So thank you to everyone, and over to you, Graeme.
Great, thanks very much, Brenna. Thanks, Lise. And thanks everybody for joining us this morning on this topic of building financial fitness, and what exactly does that actually mean, and what does it have to do with our financial wellness. So very much focusing on us as individuals and as a household. What I'd like to start off with is this quote from Benjamin Franklin, which I didn't realize most of the quotes we mention every day, most of them come from Benjamin Franklin. It's one of the forefathers of the United States of America. And I kind of changed it a little bit because I really like this one. He said, ultimately your net worth is made up of your good habits minus your bad habits. And I thought that was very, very fitting for this presentation, because ultimately what I really would like to get through to everybody this morning is all about the good habits. And by having good habits, we'll actually help to all build our financial wellness and our fitness. Very important to drop the bad habits and try to get into a good rhythm of being disciplined within our finances. I also just like to very quickly just point out that I'm not a financial advisor, which means I don't sell or give advice specific on financial products. And there's a very good reason why I do not want to become a financial advisor. One is as an auditor, which I actually am as well as a qualified chartered accountant, I'd like to stay independent and be objective when I meet with my clients. So when I have a look at the full financial picture, I'm not actually out there trying to sell products to you at the same time. So just want to put that out there. I'm also not a debt collector. A lot of people get confused and think I'm a debt collector. I don't collect debts either. So yeah, my business is called Debtfin Solutions, there at the bottom. And my hashtag really is ultimately why I do what I do, is I do want to turn people's financial and personal lives around. That's really what I do. Just a very quick background on myself, and I know it was in the webinar that went up, but just very quickly, I'm a chartered accountant, still registered with SICA. I'm also registered with the National Credit Regulator because I am a registered debt counsellor, and obviously I'm also a member of the Debt Counsel Association of South Africa. So I keep very much in tune with what's going on in the industry. In fact, there's a webinar at 12 o'clock today on some very interesting topics happening out in the industry at the moment. Yeah, I completed my articles at Kessel Feinstein in Cape Town. Straight after that, through a friend, I was introduced to Investec Bank, a friend I was at school with. And I spent almost 27 years at Investec Bank, my corporate career. Amazing organization. I learned a hell of a lot at Investec. Obviously, I worked in private banking all my life. So very much how I deal with my clients today is very much my private banking philosophy, which is very client-centric and coming up with specific tailored solutions depending on the client's needs, on my client's needs. Yeah, as I mentioned, yeah, I was also head of accounting for 10 years, and I was also head of credit risk for 12 years at Investec Private Bank here in Cape Town. Never ever wanted to work in Johannesburg. So through my career, I had two national roles, one launching the private bank with Steve Helbron, with Steve launched the private bank Investec. And then also for the last 4 years, I had a national role reporting to head of credit in Johannesburg for the National Private Bank, as well as my role here in the credit in the Cape Town office. Yeah, Debtfin Solutions, what I do is I do a lot actually. As you picked up, my background is in credit risk. And that's really, I'm a specialist in credit risk and still do a lot of credit risk work for various clients. And obviously I understand debt, having been in credit all my life and approving credit. So pretty much I do classify myself as a debt review specialist, as I am a registered debt counselor, and obviously do a lot of coaching, consulting as well. I actually am an associate financial wellness counselor with Maureen Clark and Associates, who is Investec. Investec is their client. So I also support the staff from a financial wellness aspect and other corporate clients of Maureen Clark here in Cape Town. I've had a few credit risk consulting roles too, with one with OPEX Rental, which did rental solutions, which was very interesting, very different from my prior banking experience. And I'm currently with Paragon Lending Solutions, where I also do credit risk consulting to them as well. Just very quickly, a lot of people probably know my wife, Murah Shirley. She's a Hebrew teacher at the middle school, Herzliya Middle School. We've been married for 25 years. We have 4 amazing, wonderful kids. And I think the fact that, you know, that we do have a lot of kids, when I start talking about financial wellness and being financially fit, it's so important because obviously a lot of families do have kids, and kids come with all their own priorities that we need to prioritize within our budget as well. Yeah, I've got various interests, obviously finance. I enjoy property as well, and I enjoy my sport too. So getting onto the topic now of building financial fitness and exactly what that is. And very much like with credit, when I was trying to explain credit all the years, in fact, very quickly, I actually wanted to be a teacher and end up becoming a chartered accountant. So I've kind of gone back to what I really want to do is teaching and helping people with really my experience of 27 years in banking and credit. So to try and explain building financial fitness, what I did think is, and to help people put into context, is ultimately our financial life is just like a marathon. It's just going to be one long race. Okay, that is our financial life, and it's not a sprint. So it's very important that we actually get our mindset that we're in for the long haul here. And if we get everything right from the beginning, it's going to make the marathon a lot easier for us to navigate. As I put there, we need to be able to pace ourselves and build stamina all the way through our financial life as well. So like with the marathon, I'm going to get into it now. It's not going to be all plain sailing. There's going to be a lot of things that are going to come across us, which is going to disrupt our rhythm, you know, within our financial lives. And as I've got over there, COVID-19 has been almost that stumbling block that no one saw coming. I saw an interview with the CEO of Airbus recently on CNN, and he said of all the strategies and things they thought would happen, this was one they never ever had on their board. They just didn't have this in their sight, that this virus with this pandemic would hit the world and effectively planes would come to a grinding halt. So that was very interesting. So I don't think anyone really saw this coming, but COVID-19, as I put there, and I've explained to a lot of clients I've chatted to the last few months, it actually has been an ideal opportunity for all of us to take stock of our financial lives and our financial position. We were all stuck at home for the first month or two. We literally couldn't get out. And it really was a time to sit down and take stock of our finances, exactly where we are. And I'm going to touch on it all the way through my presentation, where if you haven't at this stage actually just sat down, had a good look, hopefully after today, and a couple of insights I'm going to give you, you'll be able to sit down and try and put it into practice. And absolutely, I'm going to be available after this presentation if anybody ever wants to give me a call or email me, whatever, if they're just battling with anything in terms of understanding their financial position where they are currently. So as I also put there as well, just to try and help everybody, this is not unlike improving your personal fitness. Now, if we all take our personal fitness to heart, there's no reason why we shouldn't take our financial fitness to heart as well. It is really much very, very similar. And I'm going to take you through now I've got there the 4 steps, which we'll cover again in the presentation a little bit later. So the first thing is, if we're going to take on this marathon of our financial life, the most important thing to do is to actually have an assessment. You know, if you're going to start running, and I'm sure a lot of people out there have actually done marathons. I actually haven't, but I have done quite a bit of running in my life. Is you need to assess your current health. You know, you want to get a medical checkup. Make sure there are no surprises, and do your research that you actually are up for this. That is no different from your financial life, where you actually need to, before you get going, is to assess exactly where you are. And that assessment is really a gathering of data and information. Okay. The first thing you're going to do, as with your medical checkup, which is a report on your medical health, is you're going to get a credit report, which you'll get from a credit bureau. You're entitled to one free credit report per annum from a credit bureau in terms of the National Credit Act. So that is the first place you need to start. And most clients I meet is, if they don't have a credit report, I do say, we need to get the credit report. We need to actually understand, what does your financial health look like right now? And actually, are you healthy in terms of your financial rating or your score, which we'll touch on a little bit later in the presentation again, because that is the first thing that any credit provider or anyone who's giving you any credit is going to pull up from your credit report and have a look at your credit score. And we'll touch on a little bit later in the presentation. Secondly, before we now get cracking and off we go on this marathon, this financial race of ours, is obviously, you need to plan the race. You need to work on your fitness levels. That's no different from your financial life. You need to actually set yourself targets. What do I actually want to achieve from this race? What do I want to achieve from my financial life? We've got to set ourselves targets. That is what I call the what. And then we need the how, which is, when we talk about running out, your training schedule is, how am I going to go about training to be able to run this marathon, that I'm actually going to finish it? And hopefully by the time I finish it, I'm actually in a very good physical state and healthy state at the same time. We obviously now talking about our financial state at the end of the race. So goals and plans are very important, and we're going to touch on it again further on in the presentation. Goals and plans will take on short-term, medium-term, and long-term plans. We need to, like in any race, we need to take it step by step. We need to build through this. But ultimately, you need to set yourself goals through your financial life, milestones, and how you are going to hopefully achieve those goals that you set yourself. One of the most important things I always talk about my kids every day, that when they get up in the morning, is attitude. Attitude to life is so important. Your attitude to your running, your personal fitness, and your attitude to your financial fitness is actually all exactly the same. They go hand in hand. And obviously with attitude comes commitment. We need to all be committed to take this seriously. Otherwise, like with anything, jumping on a diet, jumping off a diet, if you're not committed, you're just going to go start and stop all the way. So I think what I'd like to try and get through today is, if we build a good rhythm, it will actually make it that much easier. And I'm going to get to it now, because although it is a little bit later in my presentation. In running, as everyone knows about running, it's about your rhythm and your breathing. And same thing with your financial life. If you can get into a good rhythm, and we'll get through to the things of what a good rhythm is later in the presentation, it's just going to make your financial life that much easier. The third point I've called the race. So this is really off we go. Once we start now, we decide absolutely, I'm now going to work on my financial fitness, and I'm going to start this race. I think what's very important, and COVID has shown us right now, when everyone had plans going, COVID has now hit us, and that is now a point in time where now need to say, hang on a sec, something has changed, which means we need to relook at our financial plans, and are our plans still appropriate for the environment that we're currently in? So I've got the race from the beginning to the finish. It's not going to be plain sailing. As with running, your financial life is not going to be plain sailing. If we just look at running, there's the weather, literally headwinds, which could hit us as you're running. There's the condition of the road. And I keep thinking of the Comrades Marathon when I do this presentation. There's the condition of the road. You've got uphills, you've got downhills. You don't know. You think you're financially, you think you're going pretty well, and then you start getting stitches. You're going to get those financial stitches along the way too. You're going to pick up injuries, those little niggles. Your financial life is not going to be no different. And the point I want to really make here is that monitoring is so important. We need to make adjustments and constantly reassess, are we on the right path? How is our running going? How's the marathon going, our financial marathon? Are we trying to shoot for goals which are unachievable? Do I need to change them slightly? Do I need to adjust it? So very importantly, and we'll get to it, a lot of stuff I will touch on later in the presentation, is coaching. As with running, coaching is very important. no reason why you shouldn't have a coach on your financial life too. As with personal fitness, your running fitness, coaches play a very big part in getting you right for the race. Professional advice absolutely will come into play there as well. And as I mentioned up front, I'm not a financial advisor and I'm not a certified financial planner, but there are professional people out there, and that's exactly what they do. They will focus specifically on individual products that maybe you want to take on. And absolutely, I think that's where you need to look for professional advice along the way. Then the last point, very important, I've mentioned also a little bit earlier, is the execution, which is actually the race itself. And, and breathing and rhythm, as with running and personal fitness, exactly the same with your financial life. You need to get into a rhythm that you're comfortable with and that is not going to overstress you, quite honestly, at the same time. But I think it's so important to get into some kind of rhythm, which obviously will effectively help your breathing through your financial life. And I think in terms of the execution, the discipline here is vitally important. You need to be disciplined, take it seriously, and you need to persevere. Things aren't going quite right for you. You need to see, well, how do I tweak this along the way that maybe, that will make this financial life a little bit easier for me. So you're going to have to put in a lot of effort, and consistency is most important. So a lot of things I've mentioned here today, is no different, as I say, from your personal life and from your financial life at the same time. And as I put there at the end, your financial fitness is going to set you on a path to be able to achieve your financial goals. So the fitter we get, absolutely, those financial goals that we set ourselves, we will be able to attain and reach them. Okay. But I think what's very important to understand is we're not isolated. What we want to do to our own personal financial lives is dictated to very much by what's happening out there. So I just want to have a look at the South African economy and South African landscape that we're operating in at the moment, because to be able to build a financial plan for ourselves, we need to understand the environment that we're operating in. We can't operate in our own little bubble and think, things are all okay with us. But outside, the landscape looks very different. And I'm also going to touch on, if I thought about this way, as all the other runners that are running the marathon, which is the other South African consumers, I'm going to touch on it too. Because when you buy to start that race, you look at the people on this left and right to you, like they tell you to do at university when you sit in your first lecture, the people on the right left to you, they are also going through exactly the same anxieties that we are in our financial lives and in our current lives. And everyone's got their own different plan. And when you think of all those runners out there, everyone's got a different goal. Everyone's got different aspirations. Everyone's got a different lifestyle that they attain to. So one thing I can't dictate is lifestyle, but I can help you within the lifestyle that you've chosen, how best you can go about it, achieving your goals within your personal lifestyle. So let's understand what's going on out there. And a lot of the stuff I'm talking about here is pre-COVID. So really it's the first quarter of 2020. COVID, hit us effectively lockdown end of March. And then obviously things have got certainly a lot worse for the economy since COVID has hit us. But leading up into COVID, things weren't going that well either. So let's have a look at this. So employed persons was down to just under 16.5 million by the end of the first quarter. And unemployed persons were up to 7 million by the end of the first quarter 2020. So that put there on the left, the unemployment rate, I think, had just gone just over 30% by the end of the first quarter in 2020. And clearly that number is going higher, as businesses are battling through COVID and businesses are effectively closing down. And I think what's very important at this point in time is to understand from our individual consumers aspect here, is our earnings, which I wouldn't say been bulletproof up until now, but in terms of increases, those increases that people that out there in the private sector, whatever it is, or even self-employed, they were getting every year, that just isn't going to be as it was the last few years. So that has a material impact on our budgets going forward, and understand what our budgets look like now. That income line item, thus growing by inflation merrily year after year, is not a reality anymore. In fact, some people, their earnings have gone backwards. And that has a huge impact on one's personal budget. Now, if you drop that income line item, you're looking down to your expenses and seeing where you can cut your expenses if you want to balance your budget. But Running ahead of myself, we'll get to budget in a moment. I think just understanding the inflation rate. Inflation is edging up. It was, I think, 2.2 in June 2020. We are at the bottom end of the South African Reserve Bank target range of 3 to 6%. So that is important because, as you may know, the minute our inflation goes above the target range, interest rates get increased because they try to bring inflation back within that range. The moment there wasn't much inflation, it is kicking up slightly. So we'll get to it a little bit later, but obviously that has an impact on interest rates. Our GDP fell by 2% in the first quarter, and that's now the third consecutive quarter of economic decline. And they're looking that our GDP is going to contract by up to, well, at least 7%, probably going to be higher for 2020. That has a material impact on earnings. Okay, that effectively is the same as our top line item, in our income statement. That's going to have an impact on that. Debt at the same time, as everyone is battling with personal debt, their own personal debt levels that they've got. The country as a whole, we're battling. I mean, our gross national debt is going to be close to 4 trillion rand, almost 82% of GDP by the end of this fiscal year. I mean, that number, I think, was in the mid-60s not so long ago. So that's a problem. If you look at us as a country, that means our interest. We're spending a lot of our income on just servicing the debt. No different from a lot of consumers out there, individual consumers that I come across daily, who are having issues just being able to service their debt. The South African Reserve Bank, the repo rate started 3.5%. That's a new all-time low. I think the low last 70 years. And I think there's possibly another 25-point basis rate cut still coming there. This obviously goes into the next line. The prime lending rate is now down to 7%, down from 10% at the beginning of the year. That's a 30% drop. That is a material drop in interest rates. That has helped cushion a lot of consumers out there being able to service their debt. If your income line item is held steady, your debt, your cost of servicing debt has come down materially. Okay, so that obviously has had a bit of a positive effect on some people's budgets, but a lot of people's income has been affected downwards, and costs are unfortunately not standing still. Living costs, there is still inflation out there, and I often tell people, consumers or clients with our meet, is the official inflation rate and our own personal household inflation rate are different. Okay, you just have to put your expenses down one year, have a look at what they are at the beginning of the next year, and you can work out your own personal inflation rate very, very quickly. Traditionally, probably between 10 and 12%, if you're lucky. Okay, so if your income line item is not growing and expenses are growing by more than the official inflation rate, we have got quite a bit of juggling to do to balance our budgets. Just having a quick look at the SA consumer, the state of the South African consumer out there. And a lot of people that I do meet, they really feel for the position they're in. And I do try to explain to them they're not alone in terms of everyone is battling out there. We've got 25 million active credit consumers. About 10 million, that's 40%, are actually in default, which means they're 3 months or more in arrears on their payments. Okay, that number has been about 10 million way before COVID. COVID, obviously, at the moment, everyone knows, is the banks have been giving moratoriums and holidays. The banks understand things are very different. People's earnings have been impacted, particularly certain industries operating in. Some industries aren't even operating at the moment. Hotel industries, leisure industries, for example. Business travel, obviously, the tourism industry extremely hardly hit. Tourists, no one's flying into the country or leaving the country at the moment. So that number is pretty much pre-COVID numbers. Just to put it out there, there's 1.7 trillion rands worth of consumer debt out there. That's a massive number. Those numbers on the left there are from the National Credit Regulator. Consumer debt has increased over a third now since 2008, and I'll get to it later in my presentation. The National Credit Act was brought in June 2007 for a couple of number of reasons. One was obviously to regulate the credit industry, the consumer credit industry. But despite that, credit, and particularly short-term unsecured credit, has jumped dramatically. You can see it's up 250% since 2008, whilst, let's call it secured credit, secured by mortgages over properties, has only grown by 20%. So you can see the South African consumer out there has been battling to actually balance their budgets, and they've been balancing their budgets by taking on debt, particular short-term debt, which is very expensive and which is becoming a problem because it's pretty easy to be given that credit, but to be able to pay it back is the challenge. And a lot of consumers that I come across are battling to just service the interest, never mind paying back the actual capital to pay back your debt. And that's where debt review does come into play. And I've been working with it for a few years, and it's an amazing remedy that has been given to us by the National Credit Act to be able to bring our financial lives back into kilter and to be able to finally repay that debt. And I will take you through the ins and outs of debt review and debt counseling also a bit later in the presentation. This was just very interesting survey that was done on the South African consumer. Very relevant, even though it was done in 2017 by Sanlam. It looked at financial wellness within the workplace. And this really got me thinking in terms of when I was about to leave Investec, what I was going to do in my career going forward, and absolutely getting involved with corporates, because staff are the ones within those corporates who are battling. Okay. Now, what the survey actually showed was that more than 60% of work-based stress is due to personal finances. So people are coming to work in the morning and they cannot focus on what they need to be doing with their daily job descriptions, whatever, because they're worrying about their personal financial finances and either being over indebted or worrying about the phone ringing because someone's looking for payment. So what the survey really put out there was that there was really a problem, and it's going back a few years already. There really was a problem with individual consumers and their personal finances and debt in particular. And just very quickly, the survey looked at over 1,300 well-educated professionals, 60% earning more than 300,000 Rand per annum. But what it showed was that almost 3/4 actually said they were already in financial stress. More than half of them said it was because of short-term credit. Now, I've already showed you the short-term credit numbers and what that's been doing. That number has been climbing materially in terms of the credit into the over-indebtedness of individual consumers out there. Already a third are worried about school and university fees, which have been climbing, quite honestly, year on year. This one's very important. Not enough for unanticipated expenses. Most people that I actually meet can barely balance the budget without even worrying, without even factoring in unexpected expenses. I mean, that unexpected doctor's account that you get, which is not covered by medical aid, for example. Motor vehicle expenses. I mean, most of us take our vehicles in probably once a year for service, and we kind of hold thumbs that it's just the service and not a whole laundry list of issues that's going to pop up on our vehicles, which happens every time because we do expect it, but hopefully we hopefully for once just not expecting that. But people need to be able to fund that now. Where's that money going to come from? So 1 in 3 said they were coping by reducing expenses, and that number is probably now 3 out of 3 if you ask me, if I had to update that survey. I think I think everyone is looking at how do we cut expenses. We'll touch on it just now as well. And 7 in 10 said they would have to reduce their standard of living when they retire, and that number's definitely climbed as well. And 17% of that time said they had no provision for retirement and consider themselves in trouble. We know that number's a lot higher these days. So let's get down to the nuts and bolts. After all that, we need to ask ourselves the question, how financially well are we, after that introduction by Graeme on the economy and how the economy is battling and how our colleagues and people that we know, that we see every day, are battling. This was also done a little while ago, so these numbers I think are higher. It was done 2018, Momentum UNISA South African Household Financial Wellness Index. Over 3,000 households were in the survey. More than 70%, or 70% said they don't have a financial plan. 80% said they don't have a financial planner. And 3/4 then already said, or were found to be financially unwell. That number is, I know it's a lot higher. It's shot a lot higher into the 80s, probably 90% by now. So to be financially well, if you can answer these 3 questions today, yes, then you are financially well. If you answer any of them, no, you're not financially well. And we're going to get into how we're going to improve our financial wellness and fitness in the rest of the presentation. Can we all pay our monthly bills on time? Yes or no? Can we cover unexpected expenses in our budget? Yes or no? And are we making sufficient provision for retirement? if we've answered no to any of those, we are not financially well at the moment. And we need to, as of today, if we haven't started, let's start working on our financial fitness and setting ourselves some goals and some plans to achieve those goals. We can start the race late. We don't have to always be there at the starting gun. We can join the race, but maybe we a little bit better organized to actually do pretty well in this financial, this financial life, this marathon that we're in. Very quick, I should just touch on a few things in terms of financial literacy. It's a big buzzword out there, financial literacy. What exactly is financial literacy? All financial literacy is education, knowledge, and understanding of financial matters. And we either can go get formal education, or we can educate ourselves by listening and reading and talking and having seminars and webinars, improving our knowledge and understanding of financial matters. That's why I want to touch a little bit on what's going on out there in the macroeconomic environment and the microeconomic environment, which is really ourselves, individual consumers. I did economics in my degree at university. I don't think I really understood a hell of a lot what they were trying to teach me at the time, but I've learned through my experience and working in banking and wealth investment and credit. I've actually got to enjoy it. I've actually understand it a lot better, and I can talk to people in terms of educating. But it's so important to all improve our financial literacy. Why? Because it informs our judgments to make more effective decisions. That's the bottom line. Okay, for us to be able to make some judgments and make decisions, we need to be educated and a little bit more informed than we currently were maybe in the past and currently are. Personal finance, also another buzzword. What is personal finance? All personal finance is the financial management of our money. That's all it is how do we manage our money. That is personal finance. And I'm going to get into it a little bit later because I'm conscious of time. Budgets. Also, people, what are budgets? I mean, all the budget is, it's just our spending plan of our income and expenses. Very simply put, that's what a budget is. It's how we plan on spending the income that we earn, okay, through our living expenses. And I've put there very simply put, because one thing I can't dictate is people's lifestyle, what they want to do. We can have discussions about it, and we can discuss the merits of it. And can you really afford that lifestyle? Let's talk about the Joneses, the left or right of us. Do we really want to keep up with the Joneses? Or is it more important that we make it through to the finish line in a very good financial state, and that we've actually got something to leave to our kids one day? So I think it's all part of the plan. The budget needs to be realistic in terms of the lifestyle choices that we make. And I think, you know, in terms of what's happening to us has brought a lot of people back to earth again in terms of reality of life. And life is not that easy, and income's not going to just keep growing at inflation plus a few percent, and expenses are climbing, maybe not at the same extent they were pre-COVID, but there are still expenses. I promise you right now, when we get to the beginning of the year, our medical aid, our insurance premiums, they're all going to go up. But how much? We all have to wait and see. But traditionally, that was a minimum 10%, as well as education costs as well. So there's some things, and we'll get to it now when I go through the budget, where I'm going to break down expenses to certain categories. And if anything out of this presentation, if you just walk away with one or two things, one is to walk away with expenses and understand it better. I need to break down my expenses into compartments, which I'm going to take you through now as well. Everyone understands our income. We understand our deductions. We have, you know, to get to that net pay, that net amount that ends up in our bank account at the end of the month. Then we have living expenses, which we need to cover. And I'm going to get to that in more detail in the next slide. But very simply, it's the needs and wants, the essential and non-essential. And these are buzzwords that I'd like people to actually use on their day-to-day. I do with my kids and have been for a while. And with Shirley as well. And she's very good at this. Is the minute our kids, and a lot of us have got very young kids. My kids have grown up a little bit now. Very simple. Do we need it or do we want it? Very basic. And we can start that really early on with our kids. And I maybe didn't start quite as early as I could have, but I've got my kids to understand. We talk a lot about budgets and what expenses are, needs and wants. And I think to have that conversation at any level with our kids, when you feel it's appropriate, you can have that conversation. I think it's very important. And because kids will understand it, you know, do we really need it? Need it as in it's necessary. And in our context, to keep our household going, or do you want it, which is a nice to have? That's all it is. Do you want it, or do you really, really need it? And some must say, do you really, really love it that much that you need it? Okay, so just some of the jargon or talk that we use out there. Ultimately, we want to end up with a disposable income, okay, because we need to service our debt commitments, and hopefully at the end of the day, we actually have something left over for savings. Okay, very important. Savings, obviously, short, medium, and long term. We're all looking to retirement, tax and estate planning as well. That all needs to come into which I'll touch on a little bit later in the presentation too. And that's where you do need to get professional advice, because those are very, very important parts of financial planning. Okay, let's just have a look at these budget expenses. The categories are very important, and this is just 3 categories I've just shown you up there, but I just want you just to focus on the top line. That's the most important thing. So obviously we've got different categories of expenses. I've just shown 3 here, which is utilities and security, food and groceries, and education. Just 3 categories, but there's many others which I've got in a spreadsheet, which I do go through with my clients in detail. Very importantly is fixed and variable costs. Fixed in a way we kind of don't have much control, so I call it uncontrollable, and variable, which means we do have some control on those expenses. So if we have a look at the rates and taxes there, pretty much fixed and uncontrollable, unless you want to sell the house and move to something a little bit cheaper, if you want to reduce your rates and taxes bill. But those are every year, they revalue our properties and municipal valuation, and that basically is the number that we stuck with for 3 years, pretty much so. Electricity, as an example, is a variable cost because we can control it to some extent. We can't control the cost of electricity, we can control the usage of it. So that falls under a controllable and a variable cost. Okay, that's just to get you through. And obviously, just looking at groceries and food to explain so a little bit better, clearly that's a variable, controllable cost. We absolutely can control that food bill. And that's the number when I meet my clients is way out of kilter. No one really understands their food and grocery bill. Because when I see how many in the household and the number they give me, I go, it's not possible. Okay, then you need to then break that up into essential, non-essential, and luxury. This is pretty much what a debt counselor does. As a debt counselor, when I do a affordability assessment, we break up expenses into these 3 categories, and we go, essential is what I need to keep the household going. Non-essential is a want. I can maybe do without it. And a luxury is absolutely I can do without. Okay. All my debt counseling clients, there's nothing in the luxury column and there's very little in the non-essential column. That's normally a debate about, once again, it's down to lifestyle and priority. Okay. But ultimately we end up with everything in that essential column, which is a need, which is compulsory for the household. Okay, so just to get on to, so 2 things to take away from the presentation. One is that breakdown of living expenses is to, if you haven't, is to break down your expenses. I'm very happy to help anybody after this presentation in a little bit more detail, is understanding these 5 circles, which I call the 5 circles, and pretty much like the 8 C's of credit, which I kind of work with in terms of my credit risk assessment. This, the financial planning process is a key component of personal finance, which is the financial management of our money. This is vital. And I have touched on a lot of this in the first slide where we spoke about the marathon and our financial life is a marathon, but the 5 steps are very important. The first one is assessment, is to assess our current financial position. How do we look as of today, our balance sheet and our income statement? How much debt are we carrying on our balance sheet? And how much liquidity and our assets do we have? And our income statement, which is our budget, as I mentioned earlier, in the earlier slide, is how does my income statement look? Am I balancing it? Have I got a surplus? Have I got a shortfall? If I've got a shortfall, more than likely I'm living on debt. And ultimately that thing is going to become a massive headache because maybe you're servicing the interest, but ultimately the bank wants their capital repaid. And that's where debt counseling becomes a real fantastic remedy, which does actually really can turn your financial life around. So that's very much a gathering of information and data step. Okay, getting your credit report and understanding that. Thereafter, just that first one, by the way, is I put under my counseling banner. The next really I put under my coaching banner because counseling really refers to the past and the healing and understanding the past and where we've come from. Coaching very much talks about the present and the future and how we're going to get to start setting those plans, those achievable plans to achieve those goals. And that's what a coach really does for you, is to help you, to motivate you and encourage you, and to help you in setting those goals and absolutely achieving them through the plans you're going to set. So the goals are the what, and the plan is the how. How are we going to achieve those goals? And there are various things you can factor into those goals, including personal, not only financial goals. What are my needs and wants out of life? You know, the time frames I'm going to try to do this thing. I put other things there, my tolerance for risk. What is my risk profile? You know, a lot of these things certainly a certified financial planner should be, if you ever do want to go meet and take a certified financial planner to go through your financial plan, the first thing they should start with is having a look at your risk profile, because without that, you don't understand your appetite for risk. Your plan is the how as well. And this is so important about the financial literacy, because the how is going to help here in terms of informing your judgment and helping with your decisions here, is understanding what inflation is, what are investment returns, you know, those kind of things. You need to understand that, because that's all part of your budget and that you're going to put into your plans to forecast. For example, I've got a 10-year budget. I know I'm a bit excessive, but that's what I do. I've actually got my whole plan for 10 years going forward in terms of educating my kids. Potentially they're all going to university. One is already at university. That was already the first big surprise for me. As I say, things change along the way. He's ended up at Stellenbosch University. That wasn't in my scenario planning at all, because that comes with accommodation expense now. So all the way through, you're going to have these headwinds which you need to navigate through, and you need to be flexible, and you need to be able to adjust accordingly and relook at your plans and say, are they still relevant? And are my goals still relevant? Am I still on plan to achieve those goals? The last two are vital: your execution and monitoring. Execution is ultimately, as I say, goal setting and planning is that coach. Think about your coach before you start the marathon. Once you start the marathon, the execution is monitoring. It's all up to us. Okay, the execution is how disciplined we're going to be and our perseverance through that run. You know, you get a stitch, you just keep on going. Yes, it will slow us down, absolutely. But we need to keep persevering and keep going on with that path, because we know we are on the right path, and we may need to adjust ourselves accordingly. I've got the professional assistance where required, and that's your certified financial planners and financial advisors who are properly qualified and registered. Please check them out before you guys do look for professional advice. The monitoring, as I mentioned, this is for, that's the COVID of the things. It's the going to university out of town, which you weren't expecting. It's those life-changing events and things that require adjustments and assessments to our plans. I've put down, for example, and right through our whole lives, from being single, meeting somebody, getting married, having kids, educating the kids. Those are all the things we're talking about here that we need to, which will change our plans as we go through our financial lives. Buying a home, having a family, educating, absolutely. Other very important key areas in financial planning, and this is obviously where I talk about professional advice, is obviously having the right insurance. A will is very important. Having a valid will, very important in terms of financial planning and estate planning, having a will. Insurances, very important. Tax planning, getting the right tax advice, retirement planning and estate planning, absolutely. We need to all factor this into our financial plans and get the right appropriate advice. I'm going to jump through that because I am conscious of time. I want to quickly touch on the National Credit Act, which I did mention earlier, came in 1st of June 2007. The main purpose was to regulate consumer credit, okay? And quite honestly, haven't done the job at all when you look at those numbers. Unsecured credit has gone through the roof. The whole point of the National Credit Act was to prohibit reckless lending, which I don't think we have achieved, quite honestly, and also helping consumers from becoming over-indebted. So the National Credit Act brought the debt counsellor role into play, which is what I am, a registered debt counsellor, and at the same time, debt review, which is actually the process that you go under. You don't go to debt counselling. Debt counselling is a service. You go under what's called debt review, which is the formal reorganizing or rearranging of your debt commitments. And that's what I, as a debt counsellor, do for you. I negotiate on your behalf with the credit providers, with the banks, And the sweetness about debt review is, one is to reduce your installment to what you can afford. That's why we go through your living expenses in detail. I have to do a full affordability assessment. And at the same time, the trick with debt review is to get your interest rates reduced materially, and quite honestly down to zero across your unsecured. If it solves that you can repay your debt within 5 years, your interest rates get reduced accordingly. So there's a lot of benefits to debt review. Not every client debt review is appropriate, but it is a product, and it's one of the solutions out there. A debt review works perfectly in two scenarios. One, you have no property, or you have a property but with no equity, which means you can't do a normal debt consolidation with banks. The first obvious thing is to consolidate all your unsecured debt into a facility secured by a mortgage over your immovable property. But if you had 100 or more % loan to value, that avenue does not work, and that's when debt review does come into play. And also, as if you've got high amounts of unsecured credit, which a lot of consumers do have, the debt review product is an amazing remedy. Just very quickly how it works, debt review, because I do get this question all the time, and it's probably one of the questions that will be asked, so I'm going to answer it now, is how does it work? How do you pay for debt review? Basically, debt review, what it does, say your installment is, say, 12,000 Rand a month, and we work out you can only pay 8,000 Rand a month. That becomes your payment that will go, you make one payment, 8,000 Rand a month, to what's called a payment distribution agent, who actually does all the administration and distribution of payments. It's not done by the debt counselor. I don't get involved with the money at all. It goes to a payment distribution agent, who's also registered with the National Credit Regulator. They get one payment you make to that, and they distribute the payments accordingly to how your proposal is approved by the credit providers. Okay, but the trick with debt review is, of that 12,000 Rand installment that you were making, more than likely 8,000 or 9,000 Rand was interest only, the rest was capital. We take that 8,000 Rand interest payment and turn it into an 8,000 Rand capital repayment. That is the trick of debt review. By getting your interest rates reduced down to zero, which does happen and can happen, you effectively turn an interest payment into a capital payment. And that's how you actually pay back your debt. Because you finally, that 8,000 Rand goes against your debt to amortize it. It's meant to amortize over 5 years. My debt review clients can get out within 1 to 2 years, depending on how disciplined they are and the exit strategies that we come up in terms of strategizing through debt review. So that was just very quickly how debt review works. I just want to explain, because I'm going to finish off now, just the quick difference between a credit report and a credit score, because it's very important. Your credit report is just a history of your past financial behavior in terms of how you've managed and used credit. Okay, so the credit providers send all your data through to the credit bureaus. They all differently collate that information and come up with a credit score. That credit score is a numerical value. It's a number, which is then used by the credit providers to assess you as a credit risk. Okay, it actually says, how likely are you to pay me back or default on paying me back? And that's all the credit score does for you. Okay, that's what it shows. So just very quickly there, the credit score guideline, anything over 650, a high credit score implies that you are low risk. Normally, which means that you are a low risk, theoretically equals lower interest rates, and the banks and the ads keep telling you that. Have a good credit score will help your credit interest rate, theoretically. So just be aware of that. Obviously, the lower your score get, the higher risk you are in terms of the banks as they look at you, and they are going to penalize you in the rate for that, because they are going to assess you as being a higher credit risk. So that's just the very important differentiation between the two. And the last thing I want to quickly touch on here is the credit score. It is a behavioral score that the banks come up with. So very important, they are looking at your behavior in your credit. So they're looking at your payment history, your payment profile. Yeah, how good have you been in making your payments? How much debt have you been carrying? And once you get your facility, they're looking at your utilization of your facility. How much of your facility do you use? So these are all the things that they're plugging into their formulas that generate your credit score. Obviously, negative information, as in defaults and worse, or judgments, whatever, is going to negatively impact your score. And obviously, the length of your credit history, how many times you're applying for credit, also has an impact on that credit score. Okay, so how do we improve our credit score? pay our accounts on time, pay the full installment on time, obviously, pay more if you can, and do not draw up on your full facility. Those are just the generics out there to improve your credit score. Okay, so don't keep getting these massive facilities and drawing up on them. You know, that is, they're going to look at you as a really heavy duty credit user. So that will impact on your credit score. Lisa and Brent, I think I'm going to stop there because I'm conscious of time. I'd like to take some questions. Are there any questions out there?
Thanks, Graeme. That was an incredibly thorough overview, daunting, but it's a reality that I suppose we all really have to deal with, because I think a lot of us are battling with this space. But I think it would be important just to, if anyone wants to add a question, you can pop it into the chat box. Now's a good time. But maybe while that happens, could you just share some insights around debt counselling for a minute or two?
Yeah, so I think with debt counselling, firstly, debt counselling is not for everybody. So I'm going to quickly get on to the next slide. There are 3 questions you need to ask for debt counselling. One is you need to have an income. So unfortunately, if you don't have an income, you can't go under debt review. So that's the first requirement. So this was a good question, Lisa. Secondly, your income needs to cover your living expenses. Your expenses can't be more than your income, because then you're negative and you've got nothing over to actually pay back your debt, your installments. So you need to have what's called a distributable amount available after your living expenses, which I go through and I get 3 months bank statements, and we go through your living expenses in detail. You know, that is one of the responsibilities of the debt counselor, is to do that affordability assessment. Thereafter is what is available is we then approach the credit providers with a proposal. And as I mentioned that case earlier, if it was 12,000 you're paying, but we've only got 8,000 available after going through, the 8,000 is the proposal that we will make to the credit providers. And obviously the only way to get around that is the credit providers all bought into something called a DCRS, which is a rules-based system, which says that if your unsecured credit is repaid within 5 years, they will effectively reduce your interest rates accordingly. So that is the trick. That's why I say debt review works extremely well when you've got high amounts of unsecured credit, or you have no property, or there's no equity left in your property. Up until that stage, the banks are quite comfortable to a point to do debt consolidations, consolidate your unsecured, your credit card back into your home loan, if your loan to value is still appropriate in terms of the banks looking at your loan to value. So, as I say, debt review is not for everybody. I know the debt counselling call center firms, as I call them out there, it's a product for them. They'll sell it to anybody. I'm very specific on who I think qualifies and who it works best for in terms of when I see my clients. As I say, it's sometimes the 3rd or 4th option that I look at. But I know very clearly upfront quite quickly if I think it will really work in anyone's scenario. As I say, particularly if you're really just battling with unsecured credit, that's what it's there for, is actually to afford you the ability to finally repay back your debt.
There is a question here. Can you have debt counselling even if you're not in financial distress, but need assistance to clear any debt?
Absolutely. So debt counselling talks about being over-indebted or potentially thinking you're going to get yourself into financial trouble. So if you see down the line, things are changing, my income is being impacted and is being impacted going further, and I am no longer going to be able to afford my installments, absolutely you can approach a debt counselor, and we can look at already approaching the banks. You can be proactive with that, but we need to obviously have reasons why our income is going to be impacted and why we won't be able to afford those installments going forward. So absolutely, you don't have to be over-indebted, but obviously it's for people who are already over-indebted. But if you are battling financially and you just see yourself can't coming out of it, absolutely, let's talk about it. And debt review could be an option. And Lisa, I think what's very important is debt review is not forever. Okay. So what's very important just on this question is, so ideally they want you to repay your unsecured credit within 5 years. Okay. But you may also have a mortgage, okay, which is also under debt review. The minute you've paid back all your unsecured, which means anytime, 12 months, 18 months, and we can show the credit provider that you can still service your mortgage loan. You will exit debt review. It's not forever. Fortunately, the debt counseling firms and that, they try to keep you in there because they're running a business. Okay, I get a lot of questions from people already under debt review, and I can't get out, or nobody wants to help me get out of debt review, or how do I get out of debt review? I get a lot of those questions. And secondly is, very important, debt review is a mechanism in which to help you reorganize your installments. It's not forever. In fact, the quicker I get my clients out of debt review, the more successful I think I've been.
Great. Okay, thanks so much, Graeme. This has really been an insightful session. Really appreciate your time. Thanks everyone for joining us, and we look forward to seeing you all next week for the next webinar. Thanks so much.
Right. Thanks so much, Lisa. Thanks, everybody.
Pleasure. Bye.
Thanks. Bye.